Broke, but bold. That's the best way to describe Gen Z investors in 2025. According to brand new data from the JP Morgan Chase Institute, Gen Z and lower income households are piling into the stock market at rates never seen before. In fact, they're 5 times more likely to invest than they were just a decade ago. That's a historic shift. But here's the catch. While they're putting more money into stocks, they're saving far less than previous generations. And that creates a paradox. A generation betting on the future of the markets while living with thinner financial safety nets. So, what's driving this surge? What are the risks and the opportunities? And what does it mean for markets in the US, the UK, Australia, and Canada? Let's break down why this trend matters and whether Gen Z is building wealth or building the next bubble. On August the 27th, 2025, Axios reported fresh findings from the JP Morgan Chase Institute. Gen Z and lower income Americans are now investing at record levels. The study shows that younger adults, many in their early 20s, are not just dabbling in stocks. They're committing a bigger share of their income to investing than their parents did at the same age. And it's not just the US. In the UK, younger Brits are increasingly turning to stock ISAs and ETFs. In Canada, apps like Wealthsimple have seen explosive growth among 20-something, and in Australia, younger investors are leaning into both traditional shares and the wild west of crypto, often guided by social media influencers. The bottom line, for the first time in modern history, market participation is no longer dominated by older, wealthier households. A new class of investors is entering the game, earlier, louder, and with very different motivations. So, why now? Why is Gen Z investing so aggressively despite weaker wages and higher costs of living? The first reason is housing affordability. For decades, buying a home was the traditional first step toward building wealth. But skyrocketing real estate prices in New York, London, Toronto, and Sydney have made ownership feel out of reach. Instead of saving for a down payment, many young people are channeling their money into the stock market. The second reason is technology. Zero-commission platforms like Robinhood, Freetrade, Wealthsimple, and Stake have completely lowered the barriers. Fractional shares mean you can own a piece of Apple or Tesla with just a few dollars. The third reason is social media influence. TikTok, YouTube, and Instagram are filled with finfluencers teaching, or sometimes hyping, investment strategies. For Gen Z, investing isn't just financial, it's cultural. And the fourth reason is identity and optimism. This generation has lived through multiple crises: the 2008 crash, COVID-19, inflation shocks. But instead of withdrawing, they're leaning in, hoping markets can be their way out. Together, these forces are rewriting the old narrative. Investing isn't just for the wealthy anymore. It's becoming mainstream for everyone. Now, let's be clear. This trend isn't all bad. In fact, there are some powerful upsides to having more young and lower income people in the market. First, it promotes financial literacy. The earlier people start, the more time they have to learn about risk, diversification, and compounding. Second, it builds wealth opportunities. Even small, consistent investments can grow significantly over decades, something financial advisors have preached for years. Third, it democratizes finance. For decades, Wall Street and the City of London were playgrounds for the elite. Now, participation is opening up. And fourth, it deepens market liquidity. More participants mean more activity, tighter spreads, and more efficient pricing. So, in many ways, Gen Z's entry into the markets could be seen as a positive evolution, pushing finance toward inclusivity and breaking down traditional barriers. But, of course, with opportunity comes risk. While Gen Z is investing more, they're also saving less. That means thinner safety nets. If the market tanks, they don't have the same emergency buffers older investors relied on. Many are also drawn to high-risk assets. Meme stocks, crypto tokens, leveraged ETFs, and options trading are especially popular among younger investors. The potential for big gains is real, but so is the potential for devastating losses. Then there's the finfluencer problem. Not all advice online is sound. In Australia, regulators have already raised concerns about social media money gurus, promoting bizarre wealth hacks, like manifesting money through rituals that leave young investors vulnerable. Finally, there's psychological risk. Many new investors entered during bull markets or quick rebounds, meaning their first experiences were profitable. That can create overconfidence and lead to excessive risk-taking. In short, participation is good, but participation without preparation is dangerous. And when millions of new investors move the same way way at once, it can shake entire markets. This isn't just an American story, it's happening worldwide. In the UK, younger investors are flocking to stocks and ETFs through ISAs. Platforms like Freetrade and Trading 212 have lowered the bar for participation. In Australia, we're seeing a parallel trend. Gen Z investors are diving into equities, but also crypto and speculative plays. Regulators are increasingly worried about finfluencers leading them astray. In Canada, Wealthsimple and Questrade are attracting a flood of younger users, many treating investing apps like extensions of their social media. And in the United States, the Robinhood generation is no longer a niche, they're a powerful force. Retail investors now account for roughly 20% of daily trading volume on US exchanges, a significant shift from a decade ago. What unites these countries is a shared housing affordability crisis and the digitization of investing. If owning property feels impossible, the stock market becomes the alternative path to building wealth. But the question remains, will this strategy pay off or set up the next financial shock? What does this mean for the broader market? First, expect higher volatility in certain stocks. We saw it with GameStop and AMC in 2021, and the same dynamics could reappear whenever retail investors organize online. Second, mispricing is possible. When millions of small investors chase hype, stock prices can disconnect from fundamentals. That creates opportunities for some, but risks for many. Third, institutions are watching. Hedge funds and big players now track retail sentiment on Reddit, TikTok, and Twitter to anticipate moves. Finally, this could drive a shift in capital flows. Instead of money concentrating in blue chips, retail investors often drive rallies in small and mid-cap names. That reshapes how capital is distributed across markets. In short, Gen Z isn't just participating, they're moving markets. And that has consequences for everyone, from Wall Street to Main Street. So what should you, the viewer, take away from this? If you're part of Gen Z or a newer investor, keep investing, but also build a savings buffer. Favor long-term strategies, like index funds and ETFs over chasing hype. Treat apps as tools, not casinos. And learn from credible sources, not just TikTok clips. And if you're older or more experienced, understand that retail flows matter more than ever. Be aware of how Gen Z participation can drive volatility and create both risks and opportunities. In your portfolio, the markets are no longer dominated by institutions alone. Retail investors, especially younger ones, are now a powerful force. Gen Z and lower income investors are shaking up the market in ways we've never seen before. On one hand, this surge could mean greater inclusivity, financial empowerment, and long-term wealth building. On the other, it could create fragility, bubbles, and overexposure to risk. The reality is, we're watching a financial revolution unfold in real time. So the question is, are we witnessing the birth of a financially savvy new generation, or setting up the conditions for the next market crash? I'd love to hear your take. Drop your thoughts in the comments below.